Good morning, everyone. Today, our group will present a comprehensive financial analysis comparing Tiger Company and Lion Company to firm operating in the same industry. This analysis is based on their 2024 financial statement and relevant market data. The purpose of this presentation is to evaluate their financial performance, stability, efficiency, and investment attractiveness, and ultimately provide a clear investment recommendation. Our analysis follows a structured financial framework which ensures objective and comparable results across both companies. Uh, the presentation is structured into 8 main sections, starting with the analytical framework and methodology, followed by detailed financial analysis, and concluding with an investment recommendation. We apply vertical analysis, ratio analysis, and market-based evaluation to assess performance from both an operational and investor perspective. The key objective is not only to compare numbers, but also to interpret what those numbers mean for risk, return, and long-term sustainability. Um, Purpose and methodology. The primary purpose of this analysis is to compare Tiger Company and Lion Company, which operate in the same industry, in order to identify their relevant strength, weakness, and investment potential. Our analysis is based on financial data for the year ended 30 June 2024. We use three main methods: vertical analysis, also known as common sized analysis to compare financial structure; ratio analysis, covering five key financial dimensions; qualitative assessment, considering industry, context, and financial risks. This multidimensional approach allows us to form a balanced and well-supported conclusion rather than relying on a single metric. Um, the next slide first is liquidity, which measures the company ability to meet short-term obligations. Second is solvency, reflecting long-term financial stability and capital structure. Third is efficiency, which evaluates how effectiveness assets are used. Fourth is probability, assessing the company ability to generate earnings. Finally, market perception, which reflect investor confidence and valuation. By assessing all five dimensions together, we gain a holistic view of financial performance. So I'll hand over to Thi for our next few slides. Thank you.
Yes. We begin with vertical analysis of the income statement, where all items are expressed as a percentage of sales. Tiger Company reports a cost of goods sold of 70.85%, while Lion Company reports 71. A higher gross profit margin of compared to Tiger 26.15%. Operating expenses are relatively similar for both companies, suggesting comparable operational structure. However, when we look at net profit after tax, Lion again outperforms Tiger with 9.25% versus 8.60%. And next slide, we examine the balance sheet structure using vertical analysis. Lion Company has a higher proportion of property, plant, and equipment at 54.81% compared to Tiger 46.28%, indicating a more capital-intensive operation. Tiger has a higher accounts receivable proportion, which may signal slower collection or weaker credit management. In terms of liquid reserves, Lion holds more cash, enhancing short-term financial flexibility, Look at capital structure. Lion has lower total liability at 41.33% compared to Tiger 48.02% and higher equity. This stronger equity position suggests greater financial resilience and lower long-term risk for Lion Company. And next slide. Moving to liquidity analysis, we assess each company's ability to meet short-term obligations. Tiger has slightly higher working capital, exceeding Lion by approximately 3,600. The current ratios for both companies exceed 2%, indicating strong liquidity positions. The quick ratings are also similar, suggesting both firms can cover current liability without relying heavily on inventory. However, a key difference emerges when we consider receivable collection periods. Lion collects receivable in 42 days compared to 7 to 5 days for Tiger. This faster collection significantly improves practical liquid quality, giving Lion operational advantage. Next slide. Solvency ratios assess long-term financial stability and risk exposure. Lion had a lower debt ratio of 0.41 compared to Tiger 0.48, indicating reduced reliance on debt financing. So debt to equity ratio further supports this, with Lion at 0.70 versus Tiger 0.92. Both companies have strong interest coverage ratios exceeding 7 times, meaning they can comfortably survive interest payment. However, Tiger higher leverage makes it more sensitive to interest rate increases and economic downturns. Thank you. And next.
Thank you, T. Moving on to next slide, efficiency ratio. Efficiency ratio highlights how well management utilize company assets. Lion Company significantly outperforms Tiger in receivable days, collecting payments 33 days faster. Inventory management is also stronger, with Lion holding inventory for 62 days compared to 121 days for Tiger. This results in a much higher assets turnover ratio of 1.45 versus 1.03 for Tiger. This results indicates that Lion generates more revenue per dollar of assets, reflecting superior operational efficiency and cash flow management. Moving up to next slide, profitability ratio. Profitability ratio measures the ability to generate returns for shareholder. Lion outperforms Tiger across all profitability indicators. Gross and net margins are higher, indicating stronger cost control and pricing strategy. Lion returns on assets of 16.07%, significantly exceeds Tiger 10.35%, demonstrating superior assets utilization. Similarly, Lion achieves a return on equity of 20.69% compared to 18.72% for Tiger. These results confirm that Lion delivers strong returns to both business and its investors. Moving up to next slides, slide 11, market perspective ratio. From a market perspective ratio, Lion again appears more attractive. Lion price earning ratio of 13.70 is subsequently lower than Tiger of 19.69 despite stronger performance. This suggests that Line is undervalued relative to its earning. However, Line's superior fundamentals imply greater dividend sustainability and growth potential. Moving up to next slide, slide 12, synthesis and comparison. When we synthesize result across all 5 dimensions, Line constantly outperforms Tiger. Tiger shows us slightly advantages in liquidity, but Line demonstrates stronger solvency, efficiency, profitability, and market valuation. Line performance reflect better management, stronger financial discipline, and lower overall risks. This integrated assessment clearly position Line as financial superior company. Moving up to next slide.
Yes.
Based on the comprehensive analysis, Line company is recommended as superior investment choice. And next slide is more about the references. Thank you for listening. We are happy to answer any question. Are we done?